All right, let's dive in. Today, we're talking about the language of business itself, financial reporting standards. Now, these aren't just some boring rules. Nope. They're the very blueprint that lets investors, creditors, and especially analysts see what's really going on inside a company. This is how billion-dollar decisions get made.
But think about it for a second. When you see a company report its net income, why do you trust that number? What actually gives it any power? It's definitely not the number itself. It's the shared set of principles, the whole structure that's standing right behind it. Without that structure, it's all just digits on a page, completely meaningless.
So, to really get a grip on that structure, we can't just jump into the nitty-gritty rules. We have to start with the fundamental why. Why does this entire, really complex system of financial reporting even exist in the first place? And here it is. This is the core mission statement. The whole system is built to give useful information to people like investors and lenders so they can make smart decisions about where to park their money. Should you buy this stock? Should a bank approve that loan? These are the resource allocation decisions that basically fuel our entire economy. So, here's the key takeaway. This isn't just about a company checking a box to keep the regulators happy. Not at all. The real goal here is to help the capital markets work efficiently. See, good information lets money flow to the strong, innovative companies and, away from the weaker ones. Understanding this is absolutely critical for any serious analyst. Okay, so we've got the why down. Now let's look at the who. Who are the key players that actually build and maintain this system? It really boils down to two very different roles. You've got the architects who design the standards, and then you have the enforcers who make sure everybody's actually playing by the rules. And this slide really shows a critical separation of powers. On one side, you have these standards-setting bodies. They're private, independent organizations like the IASB, which sets the international IFRS standards, or the FASB, which handles US GAAP. They're the ones who create the rules. But on the other side, you've got the regulatory authorities, like the U.S. Securities and Exchange Commission, the SEC. These are government agencies with real legal power to enforce the rules. And here's the kicker. They can even override them if they need to.
So we know who makes the rules, but how exactly do they go about it? Well, it turns out there are two fundamentally different philosophies when it comes to building a set of accounting standards. And believe me, this difference has huge implications for analysts.
All right, so you've got two main camps. On one side, you have the rules-based approach, which is the foundation of US GAAP. This is like a super detailed instruction manual that tries to provide a specific rule for every single possible situation. It draws these bright lines to leave no room for doubt. Then, you've got the principles-based approach of IFRS. This is much more of a broad framework. It trusts accountants to use their professional judgment, so it's less about the letter of the law and way more about the spirit of the law.
Here's an easy way to think about it. A rules-based system is like a specific list of house rules stuck on the fridge. Eat only in the kitchen. No hitting. Very clear. A principles-based system, on the other hand, is more like a guiding family value. In this family, we are nice and friendly to each other. Both are aiming for a good outcome, right? But their approaches are just worlds apart.
Now, whether a system is rules-based or principles-based, it isn't just made up out of thin air. Underneath all of it, there's a foundation. You can think of it as a kind of constitution for financial reporting, and it's known as the Conceptual Framework. And this blueprint is essential for, pretty much everyone involved. It guides the standard setters when they're writing new rules. It helps companies apply those rules correctly. It gives auditors a basis for their opinions. And it really helps users, like us, interpret the final statements. At the very heart of this framework are two qualities that are just absolutely non-negotiable. For information to be useful at all, it first has to be relevant. That just means it has to be capable of making a difference in a decision. And second, it must have faithful representation, which means the numbers you're seeing actually match reality. They have to be complete, neutral, and free from error. If you're missing either one of these, the information is basically broken. Then you've got these four enhancing characteristics. These are the things that take good information and make it great. It should be comparable, so you can size up a company against its competitors. It should be verifiable, meaning an independent auditor can come to the same conclusion. It has to be timely enough to actually matter. And finally, it has to be understandable to someone who's willing to put in a little homework. Now, this all sounds fantastic in a perfect world, right? But in the messy reality of the business world, you just can't always have everything. The people creating and using financial statements are constantly dealing with trade-offs and constraints. This question really gets to the heart of one of the biggest trade-offs in accounting. I mean, what do you want? Do you want information quickly while it can still actually influence your decisions? Or would you rather wait until every single detail can be perfectly, 100% confirmed? Let's take a classic example. A company has to estimate how much of its sales it's probably never going to collect. That's called its bad debt expense. Reporting an estimate right now is super timely and very relevant for investors, but you're sacrificing verifiability because the company won't know for sure which customers aren't going to pay for months, maybe even longer. Waiting for 100% certainty would make the info perfectly verifiable, but also totally useless because it would be way too old to matter. And there are two other huge constraints to think about. First, there's always a cost to produce information, and that cost can't outweigh its benefit. Second, and this is so important for analysts, financial reports simply cannot capture some of a company's most valuable assets. Things like brand reputation, a fantastic corporate culture, or a brilliant R&D team. There's just no neat number you can slap on the balance sheet for those. So after all that, the why, the who, the how, and the constraints, we finally get to the payoff. Why does any of this matter for a financial analyst? It's simple, really. Understanding the rules of the game is what gives you your edge.
And look, this isn't just some academic exercise. The source material for this explainer is crystal clear. Having a deep understanding of the framework and all the judgments and estimates that go into it is absolutely essential for an analyst to see past the reported numbers and get to a company's true performance. So here's how you can put this all into practice. It's a 4-step analytical mindset. Step 1, figure out what standard is being used. Is it IFRS or US GAAP? Step 2, dig into those footnotes and find where management made its biggest judgments and estimates. Step 3, assess how those choices actually impacted the numbers you're seeing. And finally, step 4, compare those choices to what their competitors are doing. This is how you stop being a number reader and become a true business analyst.
At the end of the day, financial statements aren't just a collection of facts. They're a narrative, a story that's been constructed within a very specific framework, with its own philosophies, trade-offs, and limitations. Knowing the rules of that game is just the first step. The real challenge, and where you bring the real value as an analyst, is learning how to read between the lines.